All right, welcome back to Bitcoin Capital. Today we're excited to have two prominent guests with backgrounds in tradFi, consulting, energy, asset management, and of course, Bitcoin. So first up, we have Gabor Gurbacs, founder of Pointsville, strategic advisor to Tether, and formerly of ETF and mutual fund pioneer VanEck. We're also joined by Pierre Samaties, global head of digital assets and Web3 at Roland Berger, who brings a wealth of experience in energy and technology sectors. So thank you guys, welcome to the show.
Thank you.
Thanks, good to be on.
Great. All right, let's start off. I think there's something, you see in Bitcoin kind of pop up all the time. It's one of these common criticisms. I think maybe it's partly born of the fact that, I think Bitcoin really came to scale around Silk Road. So, and we hear a lot about it recently with politicians and policymakers, and that's, criticism of Bitcoin around illicit activity. And I saw, Gabor, that you recently made some comments on the NASDAQ Global Financial Crime Report. I was wondering if to start off, you could maybe run us through some of your thoughts on that topic.
Yeah, I think the overall perception of Bitcoin being a significant part of illicit activity and illicit financing is just mistaken and misguided to start with. The Global Financial Crime Report by NASDAQ made literally zero mention of any cryptocurrencies, Bitcoin or stablecoins. And all the issues they've been analyzing were around the banking and financial sector, where the vast majority of the criminal finance activities go on. I would think it's more than 99%. So I think that's just something to keep in mind. I'd also note that, and I talk about this frequently, but the banking sector is the most heavily penalized sector when it comes to illicit activity. I have this pinned on my Twitter profile that since 2000, regulators fined banks 7,400 times for about $380+ billion of fines and various sort of like illicit activity related to finance. And crypto as a whole is nowhere close to that. I think there's a lot of misinformation around where illicit activity is taking place. And one report from NASDAQ I look at annually, yet again, they didn't talk about Bitcoin, stablecoins, or crypto at large at all. So I'll stop there. Again, the data suggests otherwise. I think there's some political agendas that are being pushed from certain parties, and they get disproportionate voice in the media when, again, the data suggests otherwise.
Yeah, and I think previously the chain analysis reports, they do an annual report as well. That's kind of shown the same thing, but we just can't seem to step away from this. So how do you, and if you cut it even finer, if you look at, Bitcoin and maybe even adding in stable coins as well, I'm sure it's an even smaller portion of illicit activity. So how do we get away from this, and why can't we break away from it? Pierre, do you have any thoughts on that?
Well, I think this is unfortunately only comes with time and education, right? Because as Gabor mentioned, the data clearly suggests otherwise. And in my experience, we've been advising a couple of banks on the digital asset strategy. And a common theme in the beginning is always that the compliance team has all kinds of concerns until they actually see that your compliance, if you're dealing with digital assets, is way easier and way more transparent than it would be when you use cash or when you use traditional kind of bank transfer, because all of the intermediates that are in between. So I really think it's just a matter of education. And I agree with probably the sentiment that, I mean, most of these arguments are driven a bit by a political agenda to a certain extent. It will go away with time, pretty sure.
Yeah, I think so. I mean, regulations are always in focus for Bitcoin and the digital asset industry. How do you see that evolving over the next couple of years? In terms of Bitcoin, in terms of other crypto assets, and maybe in terms of mining as well, and the exchange businesses.
Yeah. Well, I think this is probably the year, and maybe also to a certain extent the end of last year, where crypto gets regulated heavily in all kinds of jurisdiction, which isn't necessarily a bad thing. I think regulation obviously also means clarity, which means people and companies know how they can deal with the asset class, where to set up their business, and so on. So, I mean, just judging by the front runners of regulations that we see right now, which is, obviously Switzerland has been a front runner for a while, and in particular also the UAE with several, let's say, progressive regulations around the topic. I'm very certain that it will not take us a long time until companies are able to accept at least Bitcoin for the first place and stable coins in the second place. I'm not yet so sure about other crypto related tokens. I mean, just given the argument of what is a commodity, what is a security, but at least on Bitcoin, we have very clear guidelines that it's a commodity.
Yeah, but I wonder also if, is it a lack of regulations? Because if you think of the big blowups from the last cycle, that, there's often this debate, I think, especially, in the US of onshore and offshore businesses. And I think the word offshore is used as kind of a bit of a slur. And it, when you boil it down to it, typically means not American. And there's a lot of criticism of the offshore businesses, but a lot of the blowups came from highly regulated regimes. So how do you match that up to crypto being increasingly regulated when a lot of the businesses that were heavily regulated in the last sector were some of the biggest blowups?
Yeah, it's interesting. I mean, so first of all, in general, crypto is already regulated. So it's regulated largely as money. And then what's happening is that commodities and securities regulators are trying to get a piece of the action and say, oh, this is a security, this is a commodity. And so this is a standard regulatory battle that happens in other asset classes. And the activities that actually blew up some of the large businesses that were quote unquote regulated back then were just illegal activities to start with. They were mostly kind of fraudsters or stealing money in some fashion. So that is, that's illegal in most jurisdictions. And so there's not much you can do about that. So to me, I think the interesting part of regulation that Pierre referred to that's coming is like, how do you hold Bitcoin specifically or stable coins on your balance sheet? What are some of the capital requirements against it? How do you account for it? How do you include it in your annual report? So those are some accounting and service type of questions that are unclear, and that is because, again, agencies are battling against each other to find a piece of this growing market. If you think about it, there were under $100 billion, there were not really questions around what Bitcoin and all these cryptocurrencies are. Then we hit $1 trillion, and suddenly everyone wanted to regulate a piece of the market. That's natural. And if you believe that the space is going to 10 or $100 trillion, of course, governments want to understand how to deal with it. And I think that's generally positive. So I'll leave it there.
Pierre, do you have anything to add on that? Any additional thoughts?
No, I think, as I said, like, my view is that this will evolve over time, and it probably won't take a lot of time. In particular, if you look at all the nation states that are either actively mining Bitcoin already with some entities, or at least are buying Bitcoin to a certain extent. So we have a couple of states that are already putting Bitcoin on their balance sheets, whether it's official or unofficial. And I think it fits the the classic saying in crypto, like slowly and then suddenly, right? I think we just need to hit the threshold of public players that are actually committing openly that they hold Bitcoin, and then regulation will follow.
And what do you think capital markets and crypto markets look like in maybe a decade? Do you think mainstream capital markets will evolve to look more like crypto markets, or do you think regulations will make crypto markets evolve to look more like TradFi? How do you see that playing out?
That's indeed an interesting question. I think it's probably going to be somewhere in between. I think for sure the crypto markets, but also like the fractionalized stock trading market before that, has changed the way the majority expects to trade. It's 24/7, right? It's a lot of funny instruments as well that are on exchanges, which are usually then handled by these offshore entities because there's no regulation usually in the core markets for this. So, and then the second element is that I'm pretty sure that through the tokenization of private assets, we're going to see a huge wave of existing financial products and private assets being tokenized and then also being put on exchanges, with the idea of a 24/7 trading. So if I would need to make a bet, I would say the traditional markets adjust to the crypto market.
That's kind of, I think, how I would hope it will play out as well. But do you feel slightly disappointed in how things have evolved so far? I mean, I feel like at the moment that TradFi has exerted more influence on Bitcoin exchanges and the way the crypto markets work than the opposite. I think maybe 10 years ago we had a lot of optimism that we would influence, Wall Street and these kind of power centers of traditional finance. And I don't think it's really happened. I think the ETF is probably a good example of that, because they had to have Bitcoin absolutely spoon-fed to them in a securitized wrapper for them to be able to touch it. So how would you kind of mark the progress so far?
I mean, I would really say it's going to be best of both worlds, right? So we have a lot of regulation that's put now on centralized exchanges. We have some efforts which I don't think they're gonna go forward, but at least you see the regulators' interest in decentralized exchanges now as well, right? So you have a lot of TradFi rules coming to centralized exchanges, but I believe that the user experience that we're going to see in 5 to 10 years is more of a crypto experience that we know from growing up kind of in the crypto environment than it is a TradFi experience where I have closed trading hours and
Yes,
and can only buy certain units that that cannot be broken down and so on and so forth.
yeah. Gabor, I'm sure that's your view as well. Is that how you see things playing out eventually?
Yeah, and again, you see traditional exchanges adjusting. Also, like New York Stock Exchange announced, I think a week ago or so, they want to do 24/7, 365 trading, and so the world is adjusting to a more sort of like constant Bitcoin-like experience, if you will. And again, for the next 5 years, I think from the back end, we're going to run a parallel sort of universe, if you will. A lot of things will happen through centralized settlement. Settlement is a key component that is unsolved, that's not allowing the two worlds to connect, and that has a lot of sub portions that I'm not going to go on into detail. But settlement to deliver versus payment are the two sort of main areas. And I think just some of the work that you do with Bitfinex Securities, I think is creating that bridge. But realistically, what's going to happen is, again, for 5 years, we'll parallel run an environment that looks like TradFi but has a different technology front, and eventually will completely rework how things are settled and how collateral is used in transaction. And once the system is up and running, people will realize that I would think at least that system is 5 to 10 times more efficient. Fees are different, and there'll be a chance to really compete with the system in a good way. And I'm sort of on the position that a lot of the exchanges on the traditional side will evolve, and it's not we're going to kill all the exchanges, and with this new technology. But I think a lot of them will adopt the technology and serve their core customer set. So I'm bullish on that. What's interesting though is that who's going to power that ecosystem, and it's the like of Bitfinex Securities, Tether, and some of the players that were non-traditional to start with.
Yeah, the technological advantages just seem so significant that I think it eventually has to pull in that mainstream institutional money, right? Things like real-time settlement. I always say I'm in Taiwan, we're T+2, so you sell your TSMC on Friday, you don't get your cash until Monday, right? So you can, with real-time settlement on crypto exchanges, you get I think there's probably a risk management asset to that. You don't have your cash trapped somewhere for a long period of time. And then there's an efficiency aspect to that where you can churn your capital a lot more efficiently. So I think those kind of benefits. And then the trading hours, right? Like, we have ADRs and GDRs to open up, like TSMC, Honghai, Foxconn, these kind of companies to the US and to Europe. And you don't really need those anymore. That just kind of eats the whole DR industry, I think.
100%. And in addition to that, so this is I tend to call these structures token depository receipts. They're not a formal term, but they 100%, you said, eat up the whole industry. And in addition to that, since dollars don't move fast enough, the reason, for instance, USDT is a $110 billion asset is because it's much faster than traditional railways, and that's why larger corporations businesses started using USDT, which is Tether dollars, in mostly emerging markets. One thing to note is that the transformation, so there's two different worlds. There's the developed world and there's the emerging world. The developed world is very entrenched. It's going to fight this revolution and fight with everything. They have capital, they have lobby and regulations. But the emerging world has a vested interest to take advantage of this opportunity set and deploy the exchanges, use the technology to create capital formation in their countries and build their own exchange stack and capital issuance stack. So I think what the emerging world is going through, and again, with your company, Jesse, Bitfinex Securities leading this, and Tether, is basically a mobile moment that happened in Africa where landline phones were not adopted, but suddenly a lot of the users jumped onto a new technology that's better, cheaper, and faster. So that, again, I think it's just very interesting to watch and build in the space.
If I may add one thing, I think what's quite interesting to see for the next 5 years or so is I think everyone at least woke up now to this idea that there is a big market to capture around digital assets, whether it's crypto, stablecoin, or tokenized assets of existing stuff. So my view is that we're going to see a very interesting competition among minimum 7 different categories of players: centralized exchanges, decentralized exchanges, banks, traditional banks, right, the trusted custodian for let's say the traditional financial system, wallet providers, and that can be the likes of Ledger that also give you the interface to deal with your digital assets, brokers, payment service providers, and lastly all of the technology providers. So it's going to be, from my view, really interesting to watch now who's going to win this race for this multi-trillion-dollar market in the next 5 years, and who's going to capture all this customer demand.
Do you think the technology erodes the value proposition of some of those segments, though? Like, I wonder if, brokers, payment agents, custodians, when you can do direct peer-to-peer transactions, do those kind of roles become less significant, do you think?
No, what I mean with technology providers is more the people or the companies that would provide the technology for the banks, for the new brokers, and so on and so forth. So kind of provide the shovels to the gold rush to a certain extent. But your question, I think, is an interesting one, because where I don't have an answer to, and maybe you guys have, is, or I would love to hear your opinion as well on this, is the self-custody willingness, right? Because that ultimately also depends a lot where the market is going.
What do you mean by willingness?
So how many people, how many customers would really be willing to take ownership of their own custody versus rather depositing in a centralized exchange or in a bank or in a broker and let them administrate my keys?
Well, I think it depends on the asset, right? If it's a bearer asset like Bitcoin or Tether, then there's more of a reason to hold it yourself, I think, or some portion of it yourself, or have some kind of multi-sig solution. For securities, I think probably, because everybody's known in that ecosystem, and for, we have a whitelist, so that there's probably less of a reason to self-custody your securities. So I do think it's important to be able to pull them off the exchange and to move them around and do peer-to-peer trades within a whitelisted ecosystem. I don't get, Gabor, what are your thoughts on that, on people's willingness to self-custody their own assets?
I think you covered 80% of what I wanted to say, so it's great.
Sorry.
This is actually 100% the same page there. But I think what I would add to that is so the technology and user interfaces are not available today to do really efficient self-custody for mainstream. And again, things have gotten better than 10 years ago, but we are not at the point where people feel comfortable. I also think that for the next 10 years, we'll see, and I do not really like the term self-custody, but like assisted holding of the assets, where what we call custodians or administrators, like the large banks, the Bank of New York, the State Streets, the Fidelities of the world, will hold a piece of your key if something goes wrong for, recovery, for succession planning, and all it will take, and we see some of these already playing out, is a country hyperinflating your assets, then taking away your pension, and a few more collapses in larger economies, either due to inflation or government stealing assets. People will learn about it because your entire life and savings are on it. And this is the first cycle, really, when the technology is available to protect your assets. So I think, again, it's going to take 5 to 10 years to get there, and it will be a gradual process, but it will be a necessary one.
Yeah, that's interesting. It makes me, back in 2016, there was a period when Bitcoin really followed the Chinese yuan when it was being devalued. and it was just clearly a flight to capital. There's a couple other early incidents like that too, where you can see those were the exciting times of Bitcoin, when you'd have these weird macro events and then Bitcoin would like take off. That was great. I hope we see that again. Shifting gears a little bit, Gabor, you've talked before about some of these kind of balance sheet strategies of various companies, right? Like Block and Tether using Bitcoin for corporate reserves. And of course, MicroStrategy is the best known example of that. And this, I think, also was the basis for Cathie Wood's $500,000 Bitcoin target price in 2021. I think her idea was that, what if every listed company took 5% of their balance sheet and then put that into Bitcoin? Where do you think we are on that? Do you think that's been slow to evolve, or do you think there's been more signs of companies starting to do that?
Yeah, so I think, again, like I've been advocating for this for 10 years now, to put 1 to 3% of Bitcoin on your balance sheet.
Yes.
It was well before Cathie Wood heard about Bitcoin. And so so that is, companies have been considering it. What realistically happened is that, starting really in 14, 15, family offices started putting some Bitcoin on their balance sheets. Some private corporations and billionaires started doing that. So people do that. They do that, and they do in the 1 to 2% range, honestly. 5% seems aggressive to them for a single asset. Usually single asset they own, and over 5% is either part of their larger business or there's some kind of interest that they have in it. But I think the 1 to 3% range is rational. And private companies have been doing that for a while, and they just don't talk about it because they don't have to talk about it for regulatory reasons. Don't need to disclose their holdings. So I think that's one point I would make. Public companies have started doing that lately too, and I think what's driving it is basically, and it's kind of silly, but it's an accounting clarity on how you can handle Bitcoin on your balance sheet and clear tax rules around it. So that's what's driving it. You know now whether you have to market something, whether you need to market at the end of the year, or when exactly. And that's just happened, and this happened in the U.S. It hasn't happened with the rest of the world, but in these kind of accounting matters, actually the rest of the world tends to follow. So I expect more companies to put Bitcoin on their balance sheet. There's no good reason why a company shouldn't consider 0.5% to their balance sheet just to ease into things. I'm not saying 5 to 10%. I think that's a big investment, and you really need to believe in the asset. But I think it's picking up, and again, people would be surprised how many private, powerful corporations and individuals and family offices do own Bitcoin. And actually, let me just say that the large Bitcoin investment funds have all been basically made successful by family office seed investing, and they also ended up buying some Bitcoin. So it's a huge sector, larger than private equity, that people just don't even think about.
Yeah, definitely. And people start with that 1%, and then it creeps up to become 5, 10, 20, or like Bill Miller 50%, like really quick, right?
Yes. Yes. And then a few that hold that are actually like really believe in the asset, end up building Bitcoin businesses and transferring their multi-billion-dollar businesses. It's fascinating. I've seen this play out multiple times. Very few people actually have the stomach to hold it to a 50% portfolio value, but I've seen a lot, riding it to 10, 20% from a simple 1% allocation, which is just powerful.
Yeah. Pierre, you've talked a lot about the transformative impact of AI and blockchain and wealth management. How do you think that kind of integration is going to reshape investment strategies, and what challenges do you think that's going to create or need to be overcome?
Yeah. I mean, if I focus on the investment part first, then I think the exciting thing we're seeing is that wealth management in the past has been obviously a very exclusive kind of offering, right? So there was a huge threshold for people to participate. And now with the combination of digital assets and AI, all of a sudden the threshold for wealth management, for actively managed wealth management, becomes non-existent. It's actually lowered to the extent that you can connect your wallet with even $10 or whatever, or $100,000, whatever you prefer, to AI trading strategies. And there are already a couple of incumbents out there that are doing it. Wisdomize is one of them. And they basically push the democratization of wealth management, which essentially means everyone can connect whatever they have. They can choose their own risk appetite. And then there is an auto trade that's managed by AI. And if this works for the digital asset industry, if this works for crypto, then I think other commodities will be a walk in the park as soon as they are tokenized.
Yeah. So where is that being used at the moment? Is that being used in traditional finance, or is that in the digital asset industry?
It's digital asset industry. I mean, however, it's actually a vehicle to bring asset managers into digital assets. So they dedicate, for instance, in the example of Wisdomize, they dedicate a certain amount of their fund to their trading strategy, and then there's a profit sharing model, for instance.
All right, got it.
But they also have a retail offering coming soon as well, which then opens Pandora's box and brings that to everyone in the globe.
But how do you do that kind of wealth management within the digital asset industry? So, because so much of it is just kind of high beta stuff, right? And we don't have the security tokens out there. We don't have, the lower volatility stuff. So how is it just rotating between, high beta crypto stuff at the moment?
You can choose your, let's say, trading range according to your risk profile, right? So if you want to be really risk averse, there's kind of a Bitcoin only option, which only then trades Bitcoin, and that's probably the most well explored assets also from an AI point of view, and then just goes in and out of Bitcoin Tether, and then tries to give you a little bit of gain. But there are also high risk baskets as well that involve meme coins and whatnot.
Go between dog with hat and Pepe coin.
Yeah, exactly. Good luck with that. So
that's right. Until you have no money left. Yeah,
exactly.
Going back to the regulatory stuff. I mean, one idea, I think we touched on it a bit earlier, but I wanted to talk about it a bit more, is the idea of having, I think Gabor mentioned, having these two different kind of ecosystems playing out, where you've got like the developing world, which might be a little bit more resistant to change, and then you've got places like El Salvador, where they're a little bit more front foot on technological adoption. They've it's better risk reward for them because they've got capital markets are a lower percentage of their GDP and financial services. How do you see that regulatory landscape playing out? And do you think that there's a big opportunity for developing markets that are willing to kind of do a deep dive into the technology?
Yeah, absolutely. And I think what people should know as sort of a background to this is just paradigm shifts and some of the demographics that are driving this all. I like to, just to contextualize, I like to say this, literally over a third of the world is under 20 years of age. Another third of the world, so this is, 0 to 20 is 1/3, and another third of the world is between 20 and 40. So the next 5 to 10 years, there's going to be literally billions of people entering the market and investing differently. So that's a lot of those people will actually enter from emerging markets. To be specific, the $35 trillion of spending by 2030 is entering into the market as younger people are becoming part of what's called the global middle class. And this is, again, like 80% of that is coming from emerging markets. So absolutely, these new technology stack, this new group just wants to invest, and there's no good ways to invest in these countries. And so that, regardless, again, like the technology aside, I think it's a demographic and sort of like social push that's driving the adoption. And what technology is doing, and like the BitConnect security, is just making these investments available to people who are not used to investing. Again, even if you go, Pierre, this, but like even if you're in Europe, like 5-10 years ago, there's just like not that much investing going on unless you're really rich or really smart. You hold your cash, maybe you earn some interest on it. You go to emerging markets today, and there's practically none. And so just those basics are being built up, and countries like El Salvador that you mentioned, Jesse, who are willing to embrace it, are just basically going to double their GDP every 5 years, or 3 to 5 years.
Well, I mean, that's interesting what you said about Europe too, and there not being that many investment opportunities, a decade ago or whatever, because it feels like the last couple of decades have, a large part of capital markets have been the world trying to get access to US markets. And as US walls things off, it feels like it might be the opposite for the next couple of decades, where the US is struggling to get access to global opportunities. Do you think that's something that could play out?
I mean, I just look at, and Pierre, you feel free to weigh in on this, but I just look at disclosures of international investments that you're not able to invest in this in, Iran, North Korea, Crimea, mainland China, and the United States. So like, that precludes a lot of American investors are already precluded from investing into a lot of kind of like, as you said earlier, offshore opportunities. I think it's a significant self-imposed disadvantage that's I think it's gonna change. And again, why it's changing so slowly is because the large guys want a piece of the pie. So
Yes.
To be specific, let me tell you this. I think 1 to 2 years from now, there'll be ETFs that are buying security tokens in emerging markets. And the large guys will find a way to buy this industry because you just can't leave this piece of action out from portfolios. And so that's one example, but people won't do it before because, again, there's just a lot of lobbying and red tape to get there. But yeah, again, it's already, there's Americans are hampered to invest from a lot of opportunities. I think, again, what will effectively happen is just new markets will be created because capital markets out of a box wasn't available before, but now it is in a rudimentary form and not with the greatest experience. But 3 years from now, it will be seamless. So you'll see countries just saying, oh, I don't have my NASDAQ and Goldman Sachs and Morgan Stanley plus banking network plus investor thing. Let's just prop it up because I have the tech. I don't need to license it from those guys.
Yeah.
and so that will change everything.
Yeah. What do you think about that, Pierre? Do you think it's realistic that some of these kind of emerging markets and these smaller economies are more front foot on the technology, that they could challenge financial centers like Switzerland?
100%. I mean, I wouldn't say. I mean, probably Switzerland is still flexible enough and capable enough to get up to speed quickly. But just to touch on what Gabor said, I really see US investors going to a big disadvantage, at least on the retail side, right? And I think this will continue because I think tokenization of private companies will first happen in emerging markets, and then the US investors are going to be left out if the current, at least retail regulations stay the way they are. Switzerland, I think, is for sure going to catch up. And to be fair, if you look at tokenization of private companies, then Switzerland is actually quite ahead in the sense they have some really nice examples, some really nice technology players that have done this end to end, like Taurus and these guys.
Great. Well, shifting gears again a little bit, Gabor, you guys at Van Eck were pioneers in ETFs and ETNs, and I think you had a Bitcoin ETN in 2020, a number of years ago, before the ETFs became really big earlier this year. What are your thoughts on the difference between this new Hong Kong ETF and the US ETFs?
I mean, I sort of predicted this 10 years ago as well. The US, so that West and the East will compete, and finally I can say that I was right. But so what's happening? Yeah, thanks. I mean, in the US it took time, and it's the largest ETF market. It's a $9 trillion market, and just for ETFs, which is again an interesting story in itself, how it grew to that size. But so US ETFs are obviously big. Some of them are multi-$10 billion strategies out there. The Hong Kong markets are much smaller, so initially, obviously, I don't expect as much flow. However, I do expect some people buy some of the Hong Kong ETFs, especially from sort of like Southeast Asia and Middle East, who don't want direct exposure because the US is just, I have to say that it's a very haphazard regulatory regime, and you don't know what agency wakes up the next morning and goes to battle in restricting capital around ETFs. So I think the rest of the world that's not US based will consider solutions in Europe and Hong Kong, but they are much smaller kind of markets. So I think the question is, and I've seen some news is whether China will meaningfully allow like mainland China to the purchase of these ETFs. It does not seem like that they are giving up on capital controls, and but if that so what will happen is that mainland China and people and businesses who have operations outside of China will likely seek direct Bitcoin exposure as opposed to ETFs that can be tracked. So I think that will boost Bitcoin directly and maybe stable coins. But that's so that would be my prediction. And let's see how things grow. I think the U.S. markets will be bigger. There is, and Hong Kong has become kind of stagnant lately. So we'll see. I'm glad they allowed it.
So what about structural differences though? Because I think the Hong Kong ETFs allow for in-kind conversions, right? Which is kind of cool. That's not something that we saw with the US ETFs at all, I don't think.
Yeah, I mean, you can do, I think through the APs, you can do sort of the in-kind redemptions. It's so what happens through APs are able to do in-kind baskets with issuers, usually authorized participants. These are large market makers and traders who exchange Bitcoin baskets to each other, converting them to ETF shares. The in-kind redemption capability is good if you have a way to hold Bitcoin, but those people who buy ETFs usually don't really have capability to hold Bitcoin directly. So I don't think it makes as big of a difference. From structurally speaking, there's not on those, like the Hong Kong products doesn't really have much structural innovation, I have to say. And from an availability perspective, actually a lot of the ETFs from Europe that are UCITS structure have been sort of like they are sold in Asia as well. So they're actually competing with some of those Hong Kong offerings. And so I think at the end of the day, it will be a price war who's offering a cheaper exposure. And that's what institutions look at.
And like you said, once the US approve it, it kind of opens the floodgates because then everyone else can do it as well. Because the first question the regulators ask are, what's the American view on it? And then everybody else kind of follows.
Yeah, I mean, it's sad because especially because the US took time. Actually, our Bitcoin ETF products ATP products were approved in Europe first, which is an interesting sort of model, and I think a similar situation can happen in tokenization too, where the rest of the world really leads. I'm curious what Pierre and you, Jesse, think about this, but I think EM and even developed Europe will be more open to tokenized assets than some of the US. But then when the US joins, it will join its size. So I think that'll be interesting. But yeah, I'll stop there.
What are your thoughts on that, Pierre? Broadly, like the trend, do you think it's more accepting in Europe, it's trending in the right direction, or?
Oh yeah, 100%. I think in general this is an acceptance movement. It cannot be stopped anymore, and I don't think the interest will go down. I think contrary is the point. And the ETFs are obviously now a great kind of entry ticket into this entire space. And as soon as people understand the underlying, then I'm pretty sure there will be a few of these ETF buyers that will convert into self-custodians at one point in time. And they'd rather want to hold the underlying rather than a piece of paper that at the end of the day would also not be theirs, right? So if something happens to their deposits.
Yeah, I wonder if you get all of these kind of more mainstream focused investors into the ETFs. I wonder what that does to price volatility for Bitcoin. Does that help take some of the edge off because you've just, everything gets a little bit bigger? Or do you get people that will get washed out with the first, 15 or 20% drop and that have, they're not the diamond hands that will hold it through those 80% corrections? So I don't know. What do you think, Gabor? Do you think the volatility has come out, or do you think it's baked into the markets?
I mean, so I think for 2 points. One is just straight up reaction is there's always new buyers, like people who didn't enter at certain levels and are watching now the space. If there's a certain, like a 10K drop, there's a lot of institutional demand that picks up coin. So that would be point one. And then point two, so I'm not worried. I guess that would be the summary. There's just, we like to say that Bitcoin just flows from weak hands to strong hands, and it's true, and it's not going to change.
Sure.
in the foreseeable future. The second part is objectively, and I don't have the stats. I do this like every year, but like I forgot the exact numbers. But Bitcoin is not as volatile as most people would think. I used to do analysis on an annual basis of comparing either like a Russell 2000 or S&P 500, Nasdaq 100 technology stocks to Bitcoin, and volatility has come down significantly. So I think the last time I looked, Bitcoin was less volatile than like a third of the Nasdaq 100, which is crazy because it's the largest and most liquid technology stocks in the market. And if you look at some of the names, I'm not going to name technology companies, but apps and things that we use every day, they're more volatile than Bitcoin. So to me, like the arguments around volatility are kind of moot, and institutions are buying, they have a long-term price target. They see it like an entry and exit range in case things go right or wrong some of the ways, and just trade it. So it's not, but it's no longer in the crazy volatile category, I would think. Bitcoin is.
Yeah, no, that's a good point. Pierre, I wanted to talk a bit about the UAE, because I noticed you've mentioned them as a blockchain hub. How is the UAE's kind of regulatory and business environment different from other places? And what lessons do you think other regions and jurisdictions can take from this model?
Yeah, I think first of all, maybe just to set things into context, in terms of the growth of the UAE ecosystem, we always do an annual kind of counting of the Web3 digital asset ecosystem together with Crypto Oasis, who are mainly running this, which is kind of the ecosystem player in the UAE. And when we did the first report in 2021, we were around like 450 something companies that were dealing with digital assets and Web3 in the UAE. And just a year later, it already went up to 1,200. And they just released the latest numbers, and we're close to 2,000 now. So there is massive growth in the ecosystem here, and that is in particular driven by very, very progressive regulation in a very business-friendly environment. Obviously, zero personal income tax helps a lot in the first place, right, to attract talent. But that aside, even the UAE started very early with a national blockchain strategy. So in 2016, they announced the first UAE blockchain strategy, where they were like more very technical targets, like by 2021, they want to get rid of all the paper in governments and do everything on chain and so on and so forth. But that sparked an entire competition among regulators, and the UAE has 7 emirates, and we have 7 regulators now that are really battling for being the most attractive place for digital assets and Web3 companies to come here. And I think we're already see that there is a real pull effect, because we have a couple of even very high profile international companies that have set up here. So it's not all homegrown companies. We really see even US companies coming over here. So I think the lessons learned, as easy as it sounds and as hard it is probably to implement that, is you just need to have a technology savvy government that at least understands the potential, and then allows for freedom of regulators, and have that business mindset of what do I need to do as a regulator to get people here, rather than what do I need to do to prevent something in the first place.
Yeah, as you said, technology savvy government, I started going through my mental, image of the G7 leadership and trying to see who would match up to that. A little bit disappointing. That's interesting. I mean, it's about free markets, it's about embracing technology, and it's about, reasonable taxation. I think it seems relatively easy, doesn't it?
Yeah, exactly. The puzzle pieces are not difficult to name, right? It's just that you need to get them in place.
Yeah, exactly right. And I think, El Salvador's model, I've kind of summarized it as, you have the Bitcoin law, and then you've got this kind of digital assets ecosystem, and then a digital asset regime. And then once that's set up, you can attract the companies and the investment. And they did kind of a similar thing too, with lowering taxes, making it more free markets, less red tape. And thinking back to like the 4 Asian dragons as well, that was kind of what they did, was, focus on education, free capital markets. So it seems like a pretty tried and tested game plan.
Yeah, absolutely.
Gabor, in light of, I saw you had a tweet about Russian ETFs. In light of freezing some of these Russian ETFs and the potential vulnerabilities of Bitcoin ETFs to similar interventions, how do you assess that from a resilience perspective, and what can be done to safeguard them?
Yeah, I mean, it was against the freezing of Russian assets in general, or really any government assets. I think it created a significant issue and trust issue with the U.S. dollar and central banks and the entire system that it created. Which I'm a big fan of the dollar. I think it was a mistake to do that, to freeze assets, and things like ETFs. I just made a note, and I'm not going to talk too much of the specifics on about this, but just the ETFs have been frozen and basically without any rules or regulations, or they were taken off market, and billions of dollars have gone to zero. This is American money burned to nothing that we're invested in Russian companies, and this has just shown the vulnerability of ETFs and mutual funds in general. They can be frozen by authorities, and they can be frozen by companies, even like brokerages and exchanges.
Sure.
And
yeah.
I know very sophisticated investors that have wild trading strategies, manage tens of billions of dollars, and this was the first time they realized that their money can be just taken away. And people in developed markets do not have the experience of their money and assets frozen and taken away. And they realized that, hey, like all this infrastructure that we build upon intermediaries, each of these points as basically a point where things can be frozen and taken away. So, that is a problem because, some cases this tool can be useful, but other cases, governments should not have this type of power over your assets. Why? Like, it can be the case that 2 years from now our country goes crazy in ESG, and if you hold oil companies, your oil companies will be taken away, sold, and you get 2 cents on the dollar. That's what happened with the Russian ETF, roughly, like around that level, like single cents on the dollar have been returned to investors, and things have been frozen and liquidated. So I think what the system that prevents this is basically some of the tokenized assets, where you hold your own assets and basically, again, eventually it will take time, but like if you hold your own assets and you're able to transact and pay with it without having central intermediaries, then your assets cannot be frozen. And guess what? Nation states that have gone through censorship, this sort of censorship, and large investors that have gone through this sort of censorship, and they're planning for their families and companies later, they're going to look at these solutions. Not because they don't trust their government, not because they don't want to work with their government, but just want to have a plan B. And so, it's just like the illustration of why Bitcoin matters and why a system that Bitcoin ushers in matters. Because the reason I'm working in this space for the past decade is because I believe that some of the tools that Bitcoin showed us can be used in capital markets and will be used in capital markets as these sort of abuses continue to happen. I'll just stop there.
Yeah, I wonder if they overplayed their hand a little bit with those abuses, and especially around the stuff that happened with COVID and things like that too, because in the last cycle, we used to hear a lot about CBDCs, and every major government was looking at CBDCs. But I think that there's been pretty robust pushback on that in every country, where there seems like there's less interest in that. And maybe optimistically, there's more interest in these bearer type assets. Maybe it's like a protest vote. I don't know if you have any thoughts on that at all, Pierre. It seems like we're not hearing as much about CBDCs anymore as we used to maybe a couple of years ago.
Yeah, but I mean, still like 90% of all central banks are doing some kind of development or pilot. So the central banks are working on it. I think for them, they clearly understood that, I mean, this entire movement with Bitcoin and everything it brings to it is a potential threat to your traditional model as a central bank, right?
Yeah.
I agree with you. There was, I think, successful pushback in the first wave of things, which then led to, I think, most of the central banks rather pivoting from a retail CDBC to a wholesale CDBC, which is more of a settlement efficiency improvement across banks, which I think is fine. But for me, still that idea of CDBCs just doesn't make any sense to me. I don't know what problem it fixes, rather than
exactly
having more downside for everyone, right?
Well, I think the problem it fixes is it gives several central bankers, I guess, one more lever that they can tweak in terms of economic crisis, right? But for the three of us on this call, there's not a lot of appeal. It's a hard sell. Yeah.
No, I opt out for sure.
Yeah, if you can, definitely. Well, that's the thing, is that once you get into it, there's a certain point where you just can't opt out.
True, but I mean, this is the beauty about Bitcoin being the alternative asset class, and hopefully, right? So
it reminds me, I was at a presentation where a government was doing a CBDC presentation. I'm not going to say where, but they were doing the presentation, and at one point when they're talking about CBDCs, the door is locked, and nobody could get out, and people were trying. And I thought, oh, this is a message from Satoshi. Like, they're trying to say something here that at some point the doors will lock and you can't get out. I thought it was perfect. So another thing with tokenization and smart contracts, and I think maybe to Gabor's point about rule by numbers rather than just people changing the rules and confiscating assets. How do you see things like AI and smart contracts and that working in with corporate governance? I mean, I think this is something that we've talked about in the digital asset space with DAOs and stuff like that for a long time. How do you see that evolving and maybe merging with security tokens so that you have corporate governance and things like that?
Shall I go first?
Yeah, go ahead, Pierre. Yeah.
All right. Well, I think for me, AI and digital assets are really the natural fit. Let me put it broader from a tech point of view. AI and blockchain are the natural fit, right? Because AI is a very centralizing technology by nature, and blockchain is in the idea world a very decentralizing technology. At the same time, obviously, we need to have a verification and truth machine to everything that comes out of AI, and we need to ensure that we're not going from one undesirable state of data where today, like the big 5 or 6 or however many you want to count, are owning all of the data and owning all of the internet economy, to a world where there will be 1 or 2 AI models that will rip you off your data and you don't get anything, right? So I think from that point of view, there will for sure going to be some interlinkage. Now, where AI and smart contracts come into play is, I'm pretty sure that in, 5 years from now, your core USP, or one of the core USPs of you as a company, no matter what sector you are, is your internal AI model. And if I would be a hacker, the worst thing I can do to you is actually not hack and steal your data. The worst thing I can do is I break into your system and I feed your AI over 12 months or 6 months with absolute nonsense. So the decisions that come out of your model are actually ruining your business. So my view is that AI needs to be on smart contracts, and there actually have been some really cool demonstrations from the folks at Dfinity and Internet Computer Protocol that showed kind of the first AI running on chain, because then it allows you to verify every input and output that comes from the model. So that's, for me, the only way this can play out technological wise. The second part to this is, I really believe that digital assets are the native transaction token for AI, right? We're going to approach a time where we're going to have an AI to AI economy where different AI models are interacting with each other. Clearly, they will do this on digital assets. They could do this on Bitcoin layer 2s, or on other forms of tokens.
Gabor, anything to add on that? Have you thought about this at all?
Yeah, I mean, to me, it's the only thing that proof of work makes Bitcoin secure. So I think it's a good transaction layer for future AIs and robots. But I think most of the crypto projects on AI are scams. There's, blockchains are just data structures, and most of them are not meant to scale. And the applicability of artificial intelligence or natural language processing or whatever model you're using is there are just not many. AI is not adding much to that. Like, so I don't. Again, I think I like separate efforts on the AI space and that are helpful for humanity and funded by the right people and have the right ethos, right? Like Tether has been investing in data centers and AI and even Evo to basically make humanity compete with AI and then make sure that there's a compute available for the right kind of AI. So as with everything else, I think setting the right incentives and having the right players with a sort of like a more peer-to-peer and freedom of markets type of perspective matters. So I was very excited to see, for instance, that are investing in this space, with Northern Data, and seeing some companies really battle the giants so that they're not the only game in town. So I think that's what matters here. I think the blockchain buzz is taking away capital from what really matters.
Interesting.
Can I add one?
Yeah, please go ahead, Pierre.
Because I think what Gabor said is important for the viewers to understand is AI and the current blockchain world, they don't really go together, right? Your kind of classic Ethereum rip-off kind of protocol, because you can't even store a simple picture on the current blockchain infrastructure. Everything that's stored in terms of data usually sits on centralized services like Amazon Web Services and so on. However, I mean, and this is why I would really encourage to check out this demo that the guys from Dfinity showed. They have an entire different infrastructure where you can actually save and compute huge amounts of data with a cryptographic layer to this. So I agree, blockchain and AI, most of the projects, I really don't see, just from a technological point of view, how they would be able to pull this off. But what I've seen in this demo was actually quite interesting because they have the compute infrastructure.
All right, I have to dig into it, learn more about it. I wanted to talk about energy markets. I know, Pierre, you have a background in energy. How do you see, we've had this thought for a long time that Bitcoin mining can drive influence energy consumption, can drive capital allocation into more sustainable forms of deriving energy. What do you think about that with this stage of Bitcoin just having passed the halving?
Oh, I mean, 100%. And most of the Bitcoin mining projects that we've worked on were for governments. And they were exactly because of this rationale, like, what do we do with excess energy? That was kind of the question. And it wasn't a project it wasn't a Bitcoin project first. It was a project about what do we do with excess energy? And Bitcoin has such great traits in terms of the mining business model, the mining operating model, that it is the perfect match for a energy world where you have a lot of fluctuating renewable energy in there that is not baseload, that just has their peaks and then goes off when the sun doesn't shine or the wind doesn't blow. And having Bitcoin miners in the system increases the utilization of these assets. So for instance, if you build a PV power plant, then you can be sure that at the peak of your production, you will have some kilowatt hours or megawatt hours that you cannot feed back into the system because the grid is just full and you're producing peak. So these hours of renewables are then curtailed. They go to waste. Instead, now comes in the Bitcoin miner that actually takes off this additional energy, hence makes the utilization of the renewable energy assets more attractive, hence leads to more development of renewable energy assets because of better economics. So for me, this is like a perfect match.
Do you think that view is being more accepted though? Because I think this is another thing, like the illicit activity argument is that Bitcoin, boils the oceans. Seems like a pretty constant narrative that we get from policymakers. Do you think that view is becoming better understood?
Well, I think we have a couple of people that really dedicate kind of all their efforts to educate. But it's I think the same argument to a certain extent. What we discussed in the beginning of the show about the illicit activity of Bitcoin, if you double click on the stats, then that's actually not the case. And I remember this hilarious article from the World Economic Forum, I think it was 2017, where they predicted that by 2020, Bitcoin will consume all the world's energy.
Yes, yeah, right? Classic. Yeah.
I mean, this is just absolute incredible to see how these kind of institutes push out these false narratives. But if you just look at the numbers, then I think for sure there is a shift in perception. we see more and more governments, we see more and more energy companies, we see oil companies, and we see waste companies that are interested in this idea of, hey, I use a decentral data center like a Bitcoin miner to actually monetize overcapacity, or even do something that's good for the climate in the sense of, using flare gas or using methane, take it out of the air, convert it into on-site power, and then mine Bitcoin.
And where do you see that happening? Do you see that happening in emerging markets or developed countries, or where's that split? Or is it just where the capital is?
Yeah, I think the two hotspots in the world right now are for sure the US, Texas, right? Because Texas has a system that's perfect for that, and the Middle East. So the entire GCC countries. Two of them are publicly known. The UAE is mining Bitcoin, and Oman is mining Bitcoin. I'm pretty sure there will be some big announcements in the next 6-7 weeks about another country coming out.
You heard it here first. Do you do you have any idea how the geographic split of hash rate looks like at the moment? I haven't looked at that in a while. I'd be interested to know, like, how is the Middle East looking in that pie chart?
I don't have the latest figures, but I would assume in the current state of things, because they just started like a year ago, so kind of there's a steep ramp up. We're probably Middle East probably below 10 still, below 10%. But if everything that has been announced that is in the plan, it's a big if, right? Comes online and the other countries don't significantly increase in the same amount, then you probably going to have 25% or even 30% of the hash rates.
I think that's really important. I think when the last cycle, when we started to see miners get really centralized in the US, because I think that was just driven by access to capital, right? And they were all trying to list, and then all of the mainstream institutional investors were investing in the miners. They were getting a really high valuation because they couldn't invest, because there wasn't an ETF, and they couldn't invest directly into Bitcoin because of mandate and regulatory restrictions. So we see all the miners go to the US, and then all the hash rate leave China, and you really don't have any balance. I think it's really important to Bitcoin if we can have more of that geographic balance, especially with slightly competing economic systems. So I always thought it was important to have some hash rate in China if possible, just because they're less likely to collude with the US and do that kind of thing. So that's great to hear that the Middle East is building up their presence in hash rate.
Yeah, absolutely.
Gabor, what do you think about the role of stablecoins in the financial ecosystem, in the mainstream financial ecosystem? How do you see that playing out? Do you think they'll be more accepted in the next, couple of years?
Yeah, again, I think I look at it sort of as the next generation of not just payment, but investment wrapper. And right now we call them stable coins, but we'll see what we end up settling on 5 years from now. But so right
what do you mean by that?
Again,
Sorry, what do you mean by that?
Yeah, there's a lot of people say deposit tokens. So entire banks are revamping their business model, just trying to be a stable coin, because stable coins enjoy broad retail distribution and characteristics that they prefer, and it's more efficient than the banking system. And I think, again, so deposit token is one of them. Stable assets is another one of them. I say that stable coins are sort of like the next great investment wrapper that enable this whole 24/7, 365 borderless and somewhat less friction type of trading and commerce. And I'm looking at the ETFs are a $9 to $10 trillion industry. I think stable coins are going to get there. The next milestone that I'm looking at for Tether is, scaling from 110 billion to $1 trillion. I know this sounds, for some people, I think that it's like a crazy thing. When it was $100 million reserve asset, people thought it was crazy, but I think 1 trillion is not unreasonable for Tether, and 10 trillion in new assets to link to stable coins, primarily I think that's still so here's a big sort of like structural issue that's coming to light, and Bitcoin has started bringing this to light. So banks are often they have very bad balance sheets. The collateral that they hold on average are probably like 15 to 17% tier one capital against the assets that you hold. So like basically for every dollar or actually, I should say, for every $100 you deposit, there's probably 15 in the bank in the form of treasuries and everything.
Yeah.
And if the bank goes bankrupt, then maybe you
Yeah.
have, a few cents in the dot. Like,
I was going to say, and they
that's
don't seem to
bad.
be particularly good at managing that either, the T-bills. Yeah. The duration
No,
mismatch and
exactly, and it's because central banks play around with it, and of course, there's very little that banks can do. But the point is that what stablecoins introduce, like Tether specifically, that hey, like you're actually holding these assets pretty directly, like these treasuries and short-term assets, without having in a bank that actually adds another layer of complexity and bad balance sheet risk. So I think banks actually are realizing that themselves. So they're trying to get some capital through this method and potentially transfer themselves. I mean, it sounds crazy, but they're looking to transfer themselves as a technology business, so they get rid of all the baggage that banking comes with. So I think that's the most exciting thing about stable coins. I wouldn't be surprised if more banks tried coming out with stable coins. And I think the question is like, who they partner with, how do they do it will matter greatly, because every bank thinks they're the smartest people when it comes to managing assets, but they have no idea how it works. Anyways, I wouldn't be surprised like if a few large banks went to Tether and asked like, how do you do this? How do I help you? How do we help each other type of scenario, which I'm seeing happening. So it's kind of, it's interesting. And I think we're going to see more of that in public.
Oh, that's very cool. And Pierre, maybe the last question for you, what lessons do you think some of the industries within the digital asset sector, maybe mining or exchanges or security tokens, what can they learn from more established industries like the energy market that you've been involved with and worked with previously?
I think they, to a certain extent, they need to get a bit more boring, right? In the sense that I think what all the established industries have done really well is obviously lobby and regulation, right? And I think especially in the first wave, 2017 to 2020, 2021, none of the digital assets players really had any focus on regulation. It was all about, we create our own world, it's gonna exist, and it's gonna eat the old world. And I think that's not going to happen, right? So there's going to be for sure a coexistence of the two, and then we're probably going to see a best of both worlds emerging. So one would really be focus on regulation, focus on lobbying, and with the lobbying, I also mean focus on education in particular, right? Because there is still a significant amount of institutions that you would need for your product to scale out there that are not really comfortable interacting with it because of a lack of education, right? That's number one. And then the second thing is, I know we're not going to get there this cycle, but hopefully in the next cycle, I just hope we're going to get rid of all of these, blockchain protocols that are just popping up, and layer 2s and layer 3s that actually have nothing new to bring to the party, but throwing money at buying corporate projects that will then, at the end of the day anyway, is going to cease to exist, because that gives the entire industry a bad image.
I don't think we're ever going to get rid of that, unfortunately. I think
maybe it gets slimmer and slimmer over time. That's my hope.
Hopefully, that's optimistic. All right. Well, to wrap things up, I've got a couple of questions from CCN, from a reporter here. So I think there's 3 in total. The first one, Gabor, is for you. Do you believe that the proposed U.S. stablecoin legislation unfairly targets Tether, potentially favoring USDC? This seems to be a pertinent issue given the legislative nuances that might impact Tether's operations. Bit of a bombshell there for you, Gabor. Let's see how you navigate this one.
Yeah, so one is Tether does not operate in the U.S., so I would just start there. And then the second part is, I don't believe that the legislation unfairly tries to treat any stable coins unfairly. It's just not how regulations work. The third point I would add is that the Tether in itself, and it's a USDT, and the treasures that Tether hold backing USDT and Tether reserves in general are net benefit to the United States. So Tether is one of the largest holder of treasuries, larger than many countries. think it's 20th. I need to look at the latest stats because it's been the reserves have been growing so fast. So I think it's just climbing up on the list. So the US dollar is basically being where banks failed and financial institutions failed for no good reason. Tether is solving that problem and transports US dollars and that to those emerging regions. So I believe while the media is coming up with all kinds of stories, decision makers and law enforcement and regulators at the highest level do know that Tether is a benefit. So again, I don't think that they would want to impact Tether negatively, because having distribution of U.S. debt and the dollar outside of the United States, particularly, Paulo shared some stats of how Tether works with various law enforcement agencies for a long time. Like it's a regulated, well-operated structure. Again, at the highest level, people do not find problems with Tether, and I believe that's a net benefit. So again, my answer would be no. I don't see a reason why it would impact Tether.
Good answer. And so the second question is about strategic focus, and it says the reporter noted that Tether's recent initiatives in the Caucasus and Central Asia, and wonders if this is a new direction for their company. And he mentioned moving outside of the U.S. Of course, Tether isn't in the U.S., so maybe we can broaden that to like Western countries or the G7. So I think boiling it down, the question is Tether focusing more on Caucasus, Central Asia, maybe emerging markets, than in Western, kind of more developed countries?
I mean, it's been known that Tether is focusing on emerging markets primarily, and it's always been the case. And Asia and the Caucasus are one of the regions, and this is where a lot of the customer demand comes from. So I think Tether is just serving customer demand and tries to enable fair and accessible commerce in region, invest in education. I particularly like those education projects that are going on in the region. So, it's fair to say that Tether is just responding to demand and tries to help educate the general public around Bitcoin and stablecoins.
And the final question here about future financial products, Pierre, maybe you can chime in on this one as well. Following the introduction of Bitcoin ETFs, are there other financial products in the pipeline that could potentially broaden the market reach of cryptocurrencies?
I think many that are gonna broaden the reach, but I would say the ones that I'm particularly excited about again is the tokenization of private companies, which is already happening in many restrictions. That's going to be a game changer once this goes mainstream. And then the second is what we touched upon earlier about the democratization of wealth management.
Yeah, that's interesting. I had the same thought too, that the ETFs are about the securitization of digital assets, and maybe the next step is the tokenization of real world assets, or STOs. Yeah. Well, that's great. I really appreciate your time today, Pierre and Gabor. It's been a really good conversation. If people want to learn more about what you're doing or what your company's doing, where can they go to learn more?
On my Twitter profile or on my LinkedIn profile. I'm pretty sure you guys are gonna link it in the comment section or something.
So good. Gabor?
Same. Twitter, LinkedIn, or whatever. Just make sure that you talk to the right Gabor. There's a lot of impersonators, so that's all I would say.
If they ask you how's your trade going, it's the wrong one.
yeah, that's not a Gabor. I'm not asking for money either. So,
that's right.
Yeah, we'll find a way to verify.
All right. Well, I appreciate your time today, guys. Thanks.